Good morning, everybody. Welcome to a holiday day in Europe today in a few countries, May Day. So, I'd like to say things are a little bit quieter, but we've had plenty of action going on already. So, hopefully it'll be a decent day. Good morning, everyone else. Good morning, Kay. How you doing?
Good morning, Ryan. Welcome to May. Yeah, we're doing pretty okay, mate. Yeah, it's been let's say a pretty decent yo-yo over the end of month. Quite a few things happened, but we are looking forward now, and especially to tomorrow, I would say.
Yes, I'm especially looking forward to tomorrow,
Oh
as
yes,
is.
true.
Sorry,
So yes, true. You're actually looking very forward to tomorrow because
very
you're
forward.
not going to be around for the NFP mess.
No, and it seems Mr. Main King. I don't. Is that a avatar name, username, or is that your real name? He's going to come up from Surrey to have a beer, and I look forward to
Oh,
meeting you,
nice.
sir. And Rahul, there we go. His name's at the bottom of the message. So yeah, look forward to meeting you, Rahul, and make yourself known. You'll know what I look like, definitely, but I won't know what you look like. So you got all the details. See you there, and that invite is open to anyone else who's up and around London tomorrow. Come and for a beer in the Oyster Shed and meet a load of market people. That's just off Upper Thames Street in London, if you need to know. Right. Anyway, let's get cracking. Start off with the Bank of Japan, which left rates on hold as largely expected. They saw absolutely zero reason to go with a hike. The statement said that they are extremely uncertain how trade policies will evolve. It says the price trend is likely still in line with their goal in their outlook for the second half of the fiscal year. Says the economy is likely to slow initially as trade policies weigh on growth. They cut their CPI forecast or core CPI forecasts, those are the important ones, for fiscal year 2025 to 2.2 from 2.4%. 2026 is under 2% now at 1.7%. 2027 also under at 1.9%. So a bit of a downbeat statement and overall from the Bank of Japan. Ueda, he was a very unhawkish set of comments from him at first. He said Japan's economy is recovering moderately, although some weak moves are seen. Says economic growth is likely to moderate. Says that the real rate is still significantly low. That's the rate they want to get into the positive, or much more into the positive, the wages over inflation. Says he expects inflation, or the bank expects inflation and wage growth to slow down due to tariffs and slower growth. Says the virtuous cycle of wages and prices will continue due to continued labour shortages, but that the timing of underlying inflation getting, or for them to achieve their 2% goal, will be somewhat delayed. Says the likelihood of the outlook isn't as high as before, and so we'll be flexible in our policy response, but it's hard to say when the certainty of the outlook will rise. Says it's not as simple in achieving the underlying inflation target as before. Timing of the next rate hike could be swayed a lot depending on the impacts of tariffs, and the timing of trend inflation does not necessarily correlate with the timing of rate hikes. So very unhawkish set of comments there, but he decided to throw a couple of hawkish bones near the end, saying that there is no change to our stance on future adjustments because we believe underlying inflation will reach our 2% target within our projection period. It says the rate hike stance is kept because the price goal is in sight and that Japan's economy is in a good shape. Trying to channel his inner pal.
Hmm. Definitely. I mean, that's how many more times do you want to walk each side of all the lines? I mean, that was worse than going through a whole shopping center. But yeah, I mean, pushing back, and all of that basically to say that they are at the same point where all the other central banks are. We want to see what's happening on trade, and then we will make further decisions. We could, it's definitely compared to the stance that they had before, and especially Ueda, it's quite a bit more unhawkish, but it still leaves a door ajar to change that stance relatively quickly, and especially from Ueda himself. Other members, we still have to hear really from them, especially the Doves, but what is noticeable or notable there is that there was mention of the wages of obviously in the statement, because they are watching those, and they are still very positive. But even they're not like really. If you read through the lines, real wages is still a bit of a question mark for when they are really turning positive for good, you know. So yes, this is a very unhawkish meeting, and I think that's going to keep the yen relatively offered for now, especially as I was looking in our chat room, and that's free for everybody to see. And I do not like to use them because they do not reflect the whole market for one, and for two, those numbers are, albeit just a few days, but they are a bit delayed, so flows can have happened in between the release and the date that they were showing for. But the CFTC data are showing very big yen longs, and especially compared to historical trends, we are at a record number of contracts. As I said, I'm trying not to hang on too much to those kind of data because I never did. But still, if you look at the trend, the market is long yen, so there may be a case for some needing to revise that a little bit, I guess. And perhaps we will be seeing a bit of managing of the books, let's say, in the positions. That was last Friday. Those numbers came out, Ryan. If you're looking for them on the 25th, was on the 25th. Huh?
Yeah, but it will show up. It will show up the charts here, I think. There we go.
No, are those not the ones that you were expecting for tomorrow? Oh yeah, okay, I see that. So they are, if you look at that over the past, even since the pandemic, they are at record highs. And then if you look at the maximum, if you click on the maximum, a little tab there, we can see that they are actually the highest since even before 2010. So the market is definitely long yen, and it was supposed to be a yen year, right? The 2025. Now let's see if it really happens in the end.
Well,
Yeah,
it
go
has
ahead.
been a yen year. If you
Oh
take
yeah.
it in 2025,
Hmm.
so they've sort of been on side. If you just take it from the year sort of thing.
Yeah, but we have seen similar in last August, right? Big drop down, and then we still went back up to 150s. Those are things in general that you have to look out for in the yen, because the yen is now really a volatile currency. But just to say that I think it's the market will need to rethink a little bit because they're clearly pushing back now. And if you then look at what the biggest uncertainty is, we heard from those officials yesterday, the Japanese officials yesterday, saying that they are still demanding just for the cancellation of the U.S. tariffs, and they have also said in Japanese they call it shoganai. We can't do anything about it. That the market will decide upon the yen levels, and they are not manipulating the yen lower. So all of that, this whole combination, I think we're in for perhaps a bout of yen weakness, or at least corrections in yen moves.
Yeah, I can agree with that because I don't think there's any chance of getting a hike at the next meeting unless things change dramatically. But, that said, they still got higher inflation numbers coming up. We saw from the Tokyo CPI much higher. If that continues, it will still make the case. But we know with the Bank of Japan that sometimes they get scared of their own shadow. And
they look at a measure that is still sticky around 1.92%, and the market looks at something different.
Yeah, exactly. So no hike today, and maybe no hike unless things materially change, at least on the trade front. So yeah, I think any hopes for the yen gaining on the BOJ is going to be short-lived for now. Right, let's get rid of that quickly. Going to look at some data as well this morning. I'll go back and find my page. Here we go. Over in the UK, some strange going on in the mortgage market. We had approvals coming in 310 above expectations, down on last month, but this mortgage lending absolutely took off. 13 billion, call it, versus 3.8 billion expected, a very big number. Now, I'm not sure what has driven this. There is some talk, people I talked to, Mr. Brown being one, that it was front running the stamp duty stuff, but that doesn't align with these mortgage numbers. If people were rushing to buy homes and get in before the stamp duty, you'd see mortgage numbers ballooning, but that hasn't happened. But someone else I spoke to said that there may be a bit of a lag going on there. Anyway, I don't know. It looks like it's wonky numbers. It probably is stamp duty front running, in which case that number is going to fall off an absolute cliff next month. Not that it's much sense for the pound anyway, not really moving on it, but at least there's still good activity going on in the mortgage market. It'd be worse if mortgage approvals were dropping and mortgage lending was dropping and everything else was dropping. We had the old consumer credit out as well. That fell to 875 million. That was in March. Now, remember, we've had good retail sales so far this year. So that consumer credit, while it's negative, it hasn't shown thus far in lower consumer spending. Okay, so, but it can be an indicator. As much as borrowing falling can, as Kay mentioned in the room, can show that people are unwilling to borrow because they can't pay it back. But that can also lead to a drop in consumer spending. Credit card spending, which is part of that 875 million, fell by 200 million. So we're not seeing a lot of money still going on the plastic. A really bad signal would be consumer credit borrowing, but most of that being put on the plastic. So credit card spending rising, that would suggest potential problems with finances, not being able to make ends meet. But we're not seeing that still. So that's still another positive for the UK. Just coming back to yesterday's data, we had the NBA stuff out, which took a bit of a wobbler last week. And it's not got that much better this week either. Purchases down again, refis down also. That's even with the mortgage rate just coming down a pip. So we are perhaps starting to see a bit of weakness coming into the mortgage market, which could then translate through to the hard housing data, which this month hasn't been too bad. But again, it's lagging. It's for March. We've seen this housing data coming in, not April. This is weekly numbers, more up to date. So just keep an eye on this purchase index. And it's not a one-for-one thing. We've had these ups and downs before, as you can see here, but we're just maybe starting a little trend lower. So just one to keep an eye on. If it keeps trending and trending and trending, then it's going to suggest problems coming for the housing market. What else did we get? We got German CPI numbers after the regional numbers coming in a little hotter than expected. In both the HICP and CPI, they came down from last month, year on year, but we're only a pip better off instead of the 2 pips expected. Then we had ADP throwing a bit of a wobbler in the mix, coming in at 62,000 versus 114,000 expected. And the market got a little bit of a shock for the first couple of minutes when it saw that number. Positives, it doesn't include government workers, so we don't know if those losses, they won't show up in this report anyway. It was still a gain, it was still a positive number. And really, that number reflects what we've heard, what we've seen from Fed heads, from surveys and whatnot, saying that hiring is slowing. It's not turning into firing just yet, but it is slowing. We saw that with JOLTS the other day as well, openings coming down as well and trending lower. So it looked a bit of a wobbly one, but it's still a jobs gain, and it's coming in alongside what we know from anecdotal evidence. Anyway, the ADP bod said that the unease is the word of the day. Employers are trying to reconcile policy and consumer uncertainty with a run of mostly positive economic data. It can be difficult to make hiring decisions in such an environment. So again, we're in a potential slowing of hiring, but not firing. Today we get change of layoffs, so we'll get to see whether the firing is picking up in that sense. Kay, what did you make of all the data yesterday? Well, that jobs data mainly.
The ADP, it was like a big loss in teaching and stuff, huh? That is perhaps not really not really good. For the rest, oh, and I just want to say about those data, something that was not really mentioned on the calendars well, or was it there anyway? But still expected was the quarterly refinancing statement from the U.S. Treasury. So basically, it came all out as expected, so that did not show anything. But then there was this subtlety of those buyback programs, and the line that struck me was that they're going to look for ways to improve it in order to get the cheapest, which is okay, I mean, very laudable, but the cheapest possible funding for the American taxpayer. That leaves the door open to changing that program at their will and managing the bond market, which is good in times of shocks. But are they going to be the next S&P, where they're going to be an active trader in the bond market? I wonder, which is not really their role, is it?
No, I expect Besant will be getting a load of questions on that today.
Yeah. Because that's so what I said as well in the room. I said the hedge fund trader has probably put that line in there. As people know, Besant used to be well, portfolio manager in some of the biggest hedge funds in the world, and maybe that leaves the door open to some strange bond activity coming from Treasury and the Fed, perhaps.
Yeah, no doubt he'll give his mates the heads up anyway when they'll be doing
Yeah. Oh yeah.
So yeah. Anyway, we'll see what he comes up with later if he does to explain that away. We've got GDP coming in from the US, and again, well, depending on which way you're looking at it, the expectations, this calendar had it at, which is Reuters, had it up 0.2, Bloomberg had it down 0.2. They were both wrong. It came in down 0.3. I think this is another case of it could have been worse. The same with the ADP, it could have been worse. Pretty much with a lot of US data at the moment, it could have been worse. There were some positives among it, like real consumer spending beat expectations, up 1.8. We had things like employment costs and benefits also staying a positive. Investment was up as well. So there were some good numbers there. It wasn't as bad as expected. We knew the possibility of a -1 based on all those imports coming in as well. Sales, though, that was a bit soggy. That's not what you want to see, -2.5%. And a big jump in PCE on the quarter as well. Now, again, that might be a bit trade related. If firms are rushing to import stuff quickly, that's an opportunity for those exporters to bump the price up a little bit and just make some extra profits, particularly if they know that business is going to drop off after that front running. So no real surprise again to see a big jump in PCE there. But later on, we got the March PCE data, because the March PCE data in the GDP number was estimated, unless they actually saw the number. But anyway, and Mr. Powell has nailed it again. He's now completed his hat trick, 3 for 3 in telling us what the PCE numbers are, 2.3 and 2.6%. After all that, we're now fully pricing 4 cuts this year by the end of 2025. That's how dovish the market has seen it. Not that prices are showing that very much. We're not seeing dollar getting sold off, in fact, dollar's quite well supported at the moment. So what do you make of that GDP data, Kay? Do we just ignore it and move on?
Well, initially I thought it was a bad one. Well, yes, we did say GDP could be a bit lower, but I found the combination between the GDP and the higher price. So, I don't like that. I'm not going to use the word stagflation yet, because we need to see what's really going to happen. And as we've already said, front loading and front running. Potential tariffs that would have had an impact on the GDP as well. It wasn't as bad as Atlanta GDP now was expecting, but yeah, and let's see what happens next. In regards to the market pricing for cuts, I need to perhaps put a bit of nuance to that, in the sense that the market is expecting cuts, but not before June, right? So the market is not expecting the next week to be a Fed cutting rates meeting, despite what President Trump would like to see. So we are not there yet, but from June, and I saw several bank expectations. They say one is even expecting 125 BPs, but yeah, most of them expect those cuts from June. I guess, as we've been saying so many times, a lot depends on where all those trade talks go. Trade is going to be one of, if not the most important thing to watch for 2025.
Yeah, and well, if we're discounting May as a moving month for a cut, that leaves them only 5 meetings to have those
Yeah,
4 cuts. So
I think,
squeezing
yeah,
it in.
it's one of the American banks, I think, who is expecting a cut at every meeting from June.
Yeah, well, no
But
surprise
okay,
there.
I mean, that still remains to be seen. We've heard so often from Powell, and the interesting line that I thought, not in his last speech, but the one just before, was that he still puts growth and employment on the same level as inflation right now. I thought it would the balance would shift quite markedly towards growth and employment, but he hasn't made that shift yet. So that, I think, is going to that is something that we need to first of all pay close attention to, if he changes that balance himself, and also keep our both feet on the ground when it comes to expecting rate cuts, because if inflation remains very stubborn in the US due to the tariffs, there may be perhaps at least one cut less.
Yeah. Right, I'll give you all something for free. If the NFP on Friday is an absolute shocker, we will be pricing 50 basis point cuts from somewhere there shortly after. You can have that one for free. That'll be as plain as the nose on my face, and I'll buy you a pint if it doesn't happen, Kay.
Oh yeah, I mean, well, you can buy me a pint any day.
I'll buy you a pint anyway. Yeah, it doesn't matter.
Yeah, yeah, let's do it. No, but I fully agree with you. The thing is, what I said is, if we get really a shocker, there's 2 things, and it will be mostly expected, but then if it's a real shocker, the bears or the bearish on the economy, I mean, will also um, have that bone in their mouth and say like, you see, we were right, and they will probably push, right. So it is going to be an important report tomorrow. We could see quite a bit of volatility.
Yeah, yeah, absolutely. Well, let's hope we see some volatility. You could deal with that. I'll be on the train. Right. Anyway, let's move on. Last bit of tidying up. We had pending home sales as well coming out, which came in a healthy up 6.1%. So again, March data showing no signs of problems in the housing market, but keep an eye on that MBA stuff, which is ahead of this lot. We have Bank of Canada minutes out saying that they debated a 25 pip cut before staying on hold. They're prepared to act decisively on clear data. Some members argued that a rate cut would be premature amid the economic uncertainty. So just a bit more colour on what we got. Obviously, Trump was out after all the GDP numbers. He praised gross domestic investment, but said the poor GDP wasn't on him. That was all down to Biden. He also said the stock market drop was not his stock market, it's Biden's stock market, even though on the 29th of January, he said it was his stock market. But there you go. Then we had Navarro appearing at his local comedy club, saying it was the best negative GDP number ever. Go figure that one out. It was a real clown show yesterday. Apparently, we've still got this stuff going on with China. It's looking like the US keeps wanting to contact China, but they're having none of it. It seems like the line China's taking is, well, you know, you've the one who acted. Until you change what you're doing, we're not going to engage with you. At least on the face of it, we already know that there's bits and pieces moving underneath the hood. But on the face of it, it seems like China's making the US sweat a bit over when they get together for talks and whatnot. So that's going to need monitoring to see how that gets resolved. Apparently, this Ukraine-US minerals deal has been signed, so that's ongoing. I thought that might have a bit more of a positive, been a bit more positive for risk yesterday, because just my thinking is if we get a deal on minerals, that effectively may lead to US boots on the ground, which isn't going to happen while they're still kicking off with Russia. So I don't know. It's maybe I'm just overplaying it a bit, but I thought that might have seen risk doing a bit better. Kay, what's your thoughts on all that going on?
Yeah, the issue there is that, as I said, I think in the room as well, Kiev, Ukraine, by signing this is also, I guess, thinking about we have to put US in front of Russia and not besides Russia, because we know that Russia and the US are in direct talks very often. There's a problem, not the whole region, but there's a problem with those regions where Russian troops are in now, and part of those regions that they claim to control are those some of them, at least parts, are where those minerals are, and I the thing is, risk positive, yes, if that means a complete calm down. But Russia may come back and say, because they've already said that they want to keep the regions where they are in control or have, I mean, the best of. So I'm not sure whether it's already risk positive, although it is the signing of a deal, which in itself is a positive factor. But it's what's going to follow, which I'm still not completely out of, to be honest.
Yeah, and you know, it puts that other slant on the war as well. You know, was this for you know, just for minerals? Was this stuff just for minerals? Because we know it's becoming a big thing with batteries and net zero and all the rest of it, and AI and chips and whatnot, and rare materials are up in demand. So what's the whole thing of Russia just wanting to grab the land that's got all the minerals in it? It wouldn't be the first time we've seen such a thing. But anyway, not going to go down that road on a Thursday. Right, that's all I've got on the headline front. I just want to point it out, Kay, the old Atlanta Fed GDP thing, Q2, they're predicting up 2.4 now.
Yeah. It's all it's going to rocket in the US in Q2 now. Huh?
Yeah, bonkers. That's why I don't listen to all these things. I don't know how they count them, and they're useless to no one. Right, anything else, Kate?
Moving on.
Good. Right, so might as well start with dollar yen. And I've got a couple of lines of thought on this one because it has been quite a big move. We've still got the volatility in it, but the decision was largely expected. Maybe, and it was touted a few days ago that they were going to cut their forecast. So again, that wasn't expected. So obviously we've seen a reaction in the yen, but for me, this is just strengthening the case for this bottom that I've been speaking about down here because we've broken up through the levels. It looks like one of those moments where the market was just waiting to get over the BOJ hump, got nothing hawkish, didn't get a hike, and then it's like, right, well, if I'm long, that risk is removed. I can continue being long or getting longer or whatever. Or conversely, some shorts also covering because they didn't get a hike to offload lower down. So we are making a very good case for a bottom down here. 145 is the next big level, as I've been highlighting for long enough. We got to 144.74. I've got a zone 90 to 145.10. So if we fail here and significantly, and we can't get through there, and again, this is another one that I'm going to keep an eye on for the end of the week. If we don't close above here at the end of this week, it's going to keep the bearishness in play. But if we stay above 142, it keeps it short-term bullish, and then we'll see what it wants to do from there. But I've definitely flipped my bias, Kay. I'm more a dip buyer than a rally seller right now. How about you?
Definitely. The thing is for me, because tomorrow's, I still think it's going to be a big number, whatever side it comes out. So I'm not yet sold completely on the global dollar positiveness, although we have to note that the dollar is doing better, a bit better overall. We've had rejections again in the Aussie. Euro dollar came down. Cable losing steam. I'm still not one on the global dollar outlook. So I still prefer to somewhere be in a cross. But I'm definitely leaning towards the short side of the yen right now.
Yeah, very much so. So I may, if we get a decent bad number, if you can call it a decent bad number, if we get a big bad number on Friday, we get a dip, and if that dip doesn't break 142, but tests it but doesn't break it, I might look to pick some up. I might pick some up anyway, depending on what the number looks like anyway. But I'm got a bit of a dip buying bias at the moment. But I'm not expecting any rallies up to 150 or anything. So I'll keep an eye on it. 144 is our immediate level right now. We've already tried to find a bit of support against it just after the break up, just in there. So we had a move up, then it held. So that's where the support's coming in at the moment. If we're back below there for any significant amount of time, then this might just be a move that hasn't lasted too long. But with all this data coming out, there's plenty of room for this to go walking around between the levels. A couple of you are asking about euro sterling. I'll have a look at this one quickly. We did have quite a significant break back above 85 yesterday, end of month stuff, or a lot of the speed. I mean, euro was getting well, this is one cross that went up. All the other euro crosses were getting clobbered at one point over the fix. But again, this just looks a bit of a speed move as well with what was happening in the euro. We're back down, knocking around the 85 level. This 84.80 is still very important. If we having a quick test of that again today or over the sessions ahead, that might spell trouble, that we're going to have a move down and we're going to keep this trend for the last few weeks going. But another hold down there, or even this middling line, 89.90, that would potentially set up again a case for a bit of a short-term bottom in play, and then maybe the long side needs to be looked at. Last one, then I'll bang it on to K. I know someone was asking about Euro Swissy. I managed to tap this one over the fix yesterday, or after the fix yesterday, down here at the 30 level. This was my important level for this move. So I've added to my ongoing longs. We've had a pretty decent bounce thus far, but we are just in a bit of a downtrend at the moment. Short term, we're getting those lower lows and lower highs. So need to keep an eye on that one. Up towards here, 93.80, 93.90 is the level we need to get above to start turning around this trend. So I'm going to be a bit tight on my trading on this portion anyway. I'm not that fussed about my 0.92s. My stop's just below this 30 level on the whole lot anyway. But so I'll manage that a bit more. Kate, just looking at the clock, going to knock it over, mate.
Sure. Just going to look at a few things. But Ali asked if there anything, if Euro Swiss was sending a message. I don't think so. I think it's a lot of month-end stuff as well. I'm not sure that we need to find a message in what happened yesterday in currency pairs. There's a lot of rebalancing being done as well, and we saw it in the euro. As Ryan already said, euro got absolutely hammered, and not only versus the dollar, but on the cross side as well. Over the end of the month, it was really yeah, it was quite a hard move on the euro yesterday. A bit expected if you look at the equity moves, but also I think there was the need to rebalance quite a bit of in the bond markets as well, and that is something that is not always clear. But yeah, on a month like April, where we had those correlations that we spoke about being thrown out of the window, there is always the risk of, at the last minute or the last day or the last couple of days, we've even said it for those rebalancing needs, right? And so that's what happened yesterday. The picture was quite messy, in fact, but then we had a bit of follow through as well. I think liquidity wise, with China already being off, with the last afternoon of the month trading in the US markets, with Labor Day today, I think there's a bit of a lack of liquidity as well. So we need to take that into account and expect perhaps some slightly bigger swings on any headline or any news. And I'm especially thinking about tomorrow as well, because some people will have the long weekend, and that's why I think we could have a pretty wobbly market tomorrow afternoon, our time zone on the NFP as well. Right. I know that a lot of people are looking at gold. I said it. There's potential for rebalancing. China being on holidays, reducing a bit of demand. Like very, very cautious, perhaps a few lines about US picking up the phone or China responding to the call. It seems that either of them or both of them are not averse to talk, but we need to be a bit cautious. But all of that, I think, was the combination for this goal to come back down. We did stop at one stage at the 50% of this April move, but we are trading slightly below. I would suspect that with as I said, China being out, that reduces the direct number of buyers in the market, if they would already need so. And on the back of those numbers, and looking ahead to tomorrow NFP, I would not rule out a bit more of this, whether it's going to stop at 3,200 or we're going to have to revisit the 61.8, which is a prior decent high. Okay, I mean, we did see a $200 correction from this level, so this is in my opinion, a relatively decent level to monitor if we see more corrective activity and come back down. When the whole thing, or when we will have the NFP, we will have to look at yields as well. If we really get a bad one, those yields are going to get a knock on the head, and that should then have a slowing down effect of this move, I would say, and perhaps find some more buyers anywhere in this zone if we would be there at that time, and we could start to get back up. On the day itself, 32.70, it looks already $50 away, but we know that we have done 100 yesterday. I think it's going to be your first resistance around 32.70, okay? And then we have this whole zone here up to 3,300. So this whole $30 zone, I think, is going to be strong enough on the day, unless something really bad happens, of course, on the day to cap the debates, okay? Um, Cable, and then I'm going to look at sterling yen as well. Cable, we did come and tag the short-term support line. There's a lot going on around 33, the figure 32.80. Take it down to even 32.70, okay, which is the 50% of, sorry, the only the 23.6% of what we've done in April in the cable. So I'd argue for as long as we are above there, the overall picture doesn't change. But I do think that we are going to probably range a little more. And we spoke about that in our room, and we are not expecting anything at all, or at least the UK people that I was asking the question to, not expecting anything at all from those local elections that we have in some parts of the UK today. So I guess you still maintain also that view that you shared, Ryan, unless we get reform. Throwing everybody overboard. But if that is the case, and I'm going to let you comment on it, Ryan. If that is the case, if it doesn't have too much of an impact, I reckon until tomorrow we are going to be moving more sideways. There is no real reason to, and I would argue for the dollar to move too much today, unless we get like something really strange on those ISM manufacturing or the jobless claims also. But I think we are going to stick in the range for a while. So on those local elections, Ryan, you think that's zero impact, right?
Yeah, I think it's little impact because I don't think there's many of them, so it's not going to be enough to give a broad outlook of things. But also, it doesn't really matter because this government's in place for the next 5 years. So it's a bit early to get investors thinking about a change of government this early. But it'll be worth for me. I'll be watching it just to see how the political landscape may or may not be shifting. We could be shifting to a three-party country from the two-party country that's been so prevalent for ever, really.
Yeah. Okay. Thank you very much, Ryan. Ryan, for that. I think it's important as well to know in general when we are expecting something, because it is a retailer thing, right? I mean, us having traded in other markets, Ryan and myself, we know, or we know how other market players that react or put importance or less importance to some factors, and it is easy to get sucked into, oh, there are local elections in the UK, or for that matter anywhere. This is going to move like hell. Not always, all right, not always. We need to um, look at the relative importance of things happening, and that's why I think it's interesting as well to just talk about this right now for 1 minute, just to tell our audience that it could be an absolute non-event as well, happening even if there are some elections. So I think a bit rangy. The one that is interesting, which I'm in right now, but same can be said for many yen crosses now, and as well the dollar yen, is that yesterday around for the end of the month we did see a move back down, but it stopped back on the bigger triangle. Now it stopped dead on. Then obviously we had the Bank of Japan, sterling yen rallying. I I still like it. I think we could be in for a bit of a test of those 193, 194 levels at some point, and then we need to revisit either one of the currencies, okay, whether it be the sterling or the yen. As I said, I think we can see more covering of long yen, and it's gonna work. I mean, probably in the dollar, but also on the crosses. But since, and then I'm going to reply to Ali. My bias on the dollar for now is a bit open. I still think we may see a lower dollar, but I need to get confirmations right now. Okay, trade will be one, but also the hard data in the US will be another one. Joao was asking about oil. Look, it's I- I've been speaking about this zone here, yeah, up to well, I mean, I was rather looking at 63.5, but we did tag the 64. We went a little bit over and then back down. OPEC is raising their output. Kazakhstan said we are going to continue to put a lot of stuff out. There is a milder summer also on the horizon if we want to become weather specialists. To me personally, there's not a lot that tells me that barring another spike what we saw, um, like we had many of them, to me there's not a lot right now that tells me that we are going to continue to to go up, you know, and I think it's been a pretty thorough rejection again of this whole zone, and it's good enough to realize. Last low here, 55 and a bit, is going to be important. I'm I can't see the longer lasting bullish picture on oil really for now. Joao, I just can't see it. It's volatile. That is one thing. If you want to trade it on a shorter term, I have difficulties to trade it on a shorter term. But look at what happened around maybe somewhere around 59 bucks. The lows here. That could be a level that you want to keep an eye on in between. But yeah, I mean this we could easily come back to those levels around 50 bucks here. I'm not going to rule much out. Perhaps the market is getting a bit ahead of itself when it really wants to push. But let's see if we get there down to 50 bucks, what's happening? Because of course we are hearing all those stories about oh, we are going all the way back down, but one step at a time, as we usually do in markets. And with that, Ryan, back over to you, mate.
Thank you very much, sir. Good stuff as always. And yeah, another show under the bridge. We've got a bit of US data later on. There's a change of layoffs coming. We've got the ISM coming all ahead. Oh yeah, and the other PMIs too. So it's a big global PMIs. So a bit of data to get stuck into. Liquidity might be a bit lacking with Europe off, but they will have their desks manned in part anyway. So yeah, have a great day, everybody, and we shall see you all tomorrow. Have a good one.